I'm your host, Thomas, and we will be discussing key trends, challenges, and investment opportunities for the coming year with two prominent guests, Koen De Leus, Chief Economist at BNP Paribas Fortis, and Philippe Gijsels, Chief Strategy Officer. We will be talking about the markets, Bitcoin, the Chinese property bubble, and uncertainties in Belgium. Welcome, Koen De Leus and Philippe Gijsels.
Thanks for having us, indeed.
Let's dive right in. To start, let's take a step back and sort of look at the broader context. How has the international landscape in Europe changed over the past 2 to 3 years?
Well, Philippe and me, we often go to presentations, and during these presentations we say we are in a fourth turning. That is 20 years of volatility, 20 years of huge chaotic environment within a period of 80 years. I leave it to Philippe to dive into that a little bit deeper, but it's having consequences, real consequences today for the European landscape. And certainly for the European trade. If you look, and if I can give 3 examples, first example, we see that there is more and more technological conversion between China and Europe. This means that more and more we see that China is a competitor with regards to technological innovations and with regards to high technology sectors, compared to, let's say, a couple of decades ago or until 2020, they were our main customers. Import of electric vehicles, import of batteries, solar, and things like that. Second element, we see that these strategic dependencies, every country has strategic dependencies, are being weaponized. Before, having strategic dependencies in a rule-based order, it's no problem. But in an environment where the strongest survive, that is where we're heading to with Donald Trump and certainly with Xi as well, that makes Europe even more vulnerable from China, rare earths, from the United States, military dependence on export. And then I just want to refer to what Mark Eskens, the Prime Minister in the 1990s, already said 35 years ago, and it was during the Gulf War. Europe is, if we look to Europe, we see that is within an economic context is a giant. Within a political environment, it is a dwarf, and within military environment, it is a worm. And even today, if we look to the economic environment, we're not so important anymore than we were 35 years ago.
Yeah, correct, but first we can add a question mark.
That is indeed the case. So that is very painful. And thirdly, we see that we have some fragmentations, very specific fragmentations in specific supply chains for specific sectors that are being disintegrated. And second, we see as well that we have fragmentation with regards to trade with some countries, certainly with the United States. And so that is the environment where we live in, and this environment is becoming very, very harsh for Europe.
Yeah. If we take a closer look at China, you've already talked about the dependencies on China, but also China as a competitor. The country is also facing a serious real estate crisis. Does that have an impact on trade relations with Europe? Yeah,
what is made in China doesn't stay in China. And that's a little bit a problem. It's a worldwide problem because what we see, because of this implosion of the real estate bubble, we see that the consumption is not there anymore, and so there's a lot of overcapacity, and this overcapacity is exported. Now the problem is as well that this overcapacity is exported more and more to Europe because of the trade war with the United States. And so this means that they are exporting deflation into Europe. So there's more competition and more goods going to Europe. This means an increasing competition. Second of all, it's pushing down prices. Import prices from China have dipped by 8%. And so this means this has a negative impact on our inflation of 0.2 to 0.3%. And so this means that for next year, we expect an inflation for the Eurozone of around 1.8%, whereas in a normal situation, we would have 2.1% or something like that.
Yeah, and what are the main causes and consequences related to this real estate crisis? And can you make a comparison with what happened in Japan in the 1990s?
That is really what our Chinese colleagues have done. They have done a deep dive into comparing China and Japan with regards to the real estate bubble. And there are some differences and there are some similarities. But one thing is for sure, we are not going to go in China into a real estate problem that lasts 20 years. Because in Japan, you have had 20 years of real estate prices that went down. You have had 2 decades, 2 lost decades. So that would be a nightmare scenario. In China, we are now in the 4th year of real estate prices that are going down. We see that the real estate bubble was bigger compared to Japan, but we see as well that the correction is going much faster. Today, in some cities, you have had already a correction of 60%. In other cities, it was 35%. But in all the 20-year period in China, you see that the correction amounted to 45%. So we are maybe almost there. And then what is very important is that China has learned the Japanese lesson. Support your banking system. Support your banking system. That didn't happen in Japan. They didn't recapitalize the Japanese banks. They did a policy that I call extend and pretend the bad loans. But at the end of the day, your balance sheet of banks is full with non-performing loans, and you can't lend anymore to the better companies. And that is the reason for these 2 lost decades. What you see in China is that they have avoided that, they have recapitalized immediately the banks, and the consequence is that today, if you look to the banking index for the Chinese market, you see it's at its highest level ever, although real estate prices are still diving and going down very hard. While in Japan, you see today, 2025, you see the Topix Bank Index is 1/3 of the level it was in 1990. And that is the big difference, and that is what makes us optimistic that, probably we will see stability in the Chinese prices in, let's say, 2 years, 3 years. Once that stability has reached, we will see more consumption from the Chinese consumers, and we will see disappearance of deflation. And as well, we will see that China is becoming very gradually, again, the 2nd engine of global growth next to the United States.
Yeah. So we can clearly see that China has an impact on our economy. If we look at the US, it's sort of a wait-and-see approach when it comes to the consequences of the American import tariffs being declared illegal by the Supreme Court.
Yeah.
What's your view on that?
Well, we'll see whether they are declared illegal or not. And the question is there, okay, is there a national emergency in the United States? I don't think there is a national emergency, but they don't ask me. Second of all, if there would be a national emergency, can Donald Trump put import tariffs on the rest of the world? And there as well, the law is clear, he can't. It's Congress that can do that, it's not Donald Trump. But we'll see what is decided. But either way, I think with regards to the trade environment, we still are going to be in a very volatile trade environment. Why? Because if the Supreme Court says, okay, it's legal what he does, you're going to have a Trump unchained. He can do whatever he wants. Nobody wants that, because for the moment he's doing already what he wants. He's being a little bit restrained by courts, but if they say, okay, you can do whatever you want, yeah, it's going to be difficult. Second, if they say, okay, this was illegal, Mr. President, yeah, at that point in time, the American administration, Donald Trump, will start to look for income from somewhere else, because they need the money to finance this big, beautiful bill. They need $3,500 billion over a period of 10 years. And so where are we going to look for that? Well, there are other sections in the trade law, and one section is on unfair trade that's been applied to China already in Trump 1 as well during Biden, and it's applied now today as well, and it could be applied at that point in time to Europe as well for this European digital tax. Second, and that is more scary, they could say, okay, these sectors, American sectors, they're too dependent of foreign import, import from the Eurozone or import from Japan. And if we are too dependent on this foreign import, okay, that is not good for the national security. So we're going to put a ban, not a ban, an import tariff on these sectors. We have seen that already with aluminium and steel, 50%. But if they do that, imagine if they do that with the European car sector, yeah, that would be detrimental, of course, for the German car industry. If they do that for pharmaceuticals, yeah, that would be very painful for the European pharmaceutical industry. So anyway, the outcome is, I don't think that we're going to go into a more calm trade environment.
Okay. And if we zoom in on our own country and on Europe, what are the growth forecasts for 2025 and 2026?
If we look to the growth forecast for our own country, we see that we have a growth forecast of around 1 to 1.1%. There's quite a lot of uncertainty around that. Quite a lot of uncertainty. Why? First of all, because if we look to Germany, yeah, is Germany indeed going to invest huge amounts of money in this infrastructure plan? They have announced that they're going to invest 500 billion euros, which is equal almost to what was spent in Europe during the Marshall Plan, and which is even more what was spent on time of the reunification between East and West Germany. That is one big uncertainty. Another uncertainty that we had until Monday was, okay, what about this budget deficit? Of course, there is the budget deficit, so we are a little bit sure about that, so that uncertainty disappears. And of course, you have the last uncertainty, and that is the trade uncertainty that we talked about.
Yeah. You mentioned a growth rate of 1.1%, a lot of uncertainty around this. Where does it all come from?
Yeah, so this trade uncertainty, if you look to this uncertainty, one of the major elements that we said is, okay, this budget deficit. And then we've done a study on this budget deficit. We've looked what the path to follow is, according to the European Commission. They say you have to reduce your primary budget deficit by 3% in 4 years, 0.7% each year. Is that difficult? If we look between 2000 and 2020, within the European Union, between the 22 biggest European countries, we don't take into account Malta or Cyprus, we see there have been 24 episodes in which countries have reduced their primary deficit by 3% in 4 years. And there have been countries that have done that 3 times, 2 countries that have done that 2 times, 14 countries that have done 1 time, and 4 countries that have not done that. And where is Belgium belonging? In these 4 countries that haven't done it. And now, of course, they have to face reality. And now, of course, we have to reduce these budget deficits. And very important there is the finding that if you reduce these budget deficits via diminishing the layouts, then you see that after the consolidation period, you will see that your growth increases by 0.5 to 1% compared to before the consolidation period. But if you do it too much via increasing the income taxes, then you see that the growth afterwards is lower compared to the growth before the budget consolidation. And I think that is a very clear message to our government.
Yeah, so it's in our best interest to sort of look at the model countries that have done this before us. Thank you, Koen. If we then look at markets and the investment trends that we're seeing, 2025 was synonymous with volatility. Will we be seeing the same in 2026?
Oh yeah, absolutely. That's one thing that's for certain, I think. We started the year 2025 by saying if you have one word in mind, probably it's going to be volatility. Well, that will be the same in 2026 and beyond, because as Koen already highlighted, this is a foreturning. And I will not start discussing, because I see Koen is already getting anxious, this book in too much detail. I can only only recommend that everybody reads it. Now, it's not an optimistic book. The Fourth Turning is here by Neil Howe. It's not something you read under the Christmas tree. It's not something you read at the swimming pool. I always say Halloween is a good period to read this book, but some way we should read it, because if you hear what Koen is saying about the world, about China, about Belgium, about Trump, about the tweets. So it all looks very random, but this book gives you some sort of a frame of reference to look at the world. And that's good, because that's what our clients expect of us, that we, through all the chaos, we see, in a way, the light. And what's happening in Belgium, everybody knows, probably, or some at least of the politicians know what measures should be taken, but it's extremely hard to implement, because you push the voters even more to the extremes. What's happening in China, what's happening, unfortunately, with all the crises we have in the world, that's all very typical for a fourth turning. So I could only remind you, read that book. Now, the point is also, fourth turning, and there it gets interesting from an investment point of view. A fourth turning is also an environment where you have structurally higher interest rates and especially higher inflation rates as well. And the good news is you can position for that. You can do, as a consumer, as an investor, as a company, you can take certain measures to make that better. And it's always easy to see the difficulties and the worries, to quote Harvey Specter, and my wife and my daughter always look at that, and accidentally I sometimes see part of them, and okay, he's a cool guy, I admit it, but he always says, where some see difficulties, obstacles, worries, risks, I only see endless opportunity. And that's also has been the year of 2025. And will be the year of 2026 as well. Yeah. Because a question we get asked very often by our viewers and our clients is, okay, with all the problems and the worries on the table, how is it possible that stock markets behave very well? Well, there are a number of reasons for that, and the first I've already mentioned. A fourth turning is inflationary. Well, the action that an investor could and should take probably is to invest in real assets. And jokingly always say that our old-timers and pigeons and jewelry and commodities and wine, absolutely, and whiskey, why not? And also real estate, clearly, and also equities, because if you buy a company, a stock on the equity market, you buy a part of a company, that's a real asset. That's one thing. Koen has run us through a reasonable time frame for the way he typically does to the different blocks. So, but if you look at all the different blocks, and you also mentioned the fragmentation of the world, we can no longer talk about one world economy. We should really look at the different blocks, which is also a consequence of this fourth turning. But all the blocks are stimulating the economy. If you look in Germany, and it's not been highlighted enough in the press, but that's very big. That's a Marshall Plan. That's 2 times the reunification. That's a lot of money, and they will put it in the system. Okay, it takes too much time, but they're doing it. Federal Reserve is cutting interest rates. China, to get out of their balance sheet recession, basically, they will have to stimulate the economy in the fiscal way, maybe also in the monetary way. A little bit further, Japan, same thing. They will have to stimulate the economy. So if you look at stock markets, the stock market needs liquidity to go higher. It's like the fuel to drive the rally. Well, the fuel is going to come from all the different blocks. So that's been the case in 2025, will once again be the case in 2026 as well. And a third point, and I've already mentioned it as well, in a way, we always look at the challenges and the difficulties, but we should not forget that the train of progress is gradually marching on. We have an extremely exciting time at the moment in terms of development and technology, in biotech and pharmaceuticals. So a lot of very interesting opportunities are arising. And I think, like Harvey Specter says, I've been doing this for a very long time now, longer than I care to remember. I've rarely seen so much opportunities. I see opportunities in biotech. I see opportunities in small caps in Europe. I see even opportunities in China because, okay, they will stimulate the economy. The money will have to go somewhere. What you said, it was probably an accident, but it was very intelligent what you said. What is made or built in China moves around the world. That's the same for capital as well. So the Chinese have invested quite a bit in the real estate market and in the US. Okay, US is maybe a no-go anymore. Maybe some will go back to the real estate market. But at the moment, all the savings in China, and that's a huge amount of savings, that's maybe the highest, biggest savings pool around the world, only 5% is invested in the equity market in China at the moment. So if only a bit moves there, we can have a boom. So I think we should be positive on China as well. And like Koen said, if they start to export inflation again instead of deflation, if they start putting money around the world again, they grow a bit better, they become the second engine of the world, well, commodity prices will do well. So I think there are, we should maybe do a next episode with all the opportunities, but I see a lot of things happening, and I think there is a reason why stock markets are doing well at the moment.
I think one of the big opportunities, everyone's talking about it, is technology. And with technology, in 2025 came AI. I'm assuming that's going to be the same in 2026.
Yeah, and that's a second big question we always get from our clients. First of all, why stock markets go up, even though there are clear and present dangers everywhere. Secondly, is AI in a bubble? And then you can be an economist or a strategist to say, yeah, maybe a yes or no. I will be more blunt and I will be more straightforward. I don't think there is a bubble. What I'm not saying is that NVIDIA cannot drop 30 or 50% from these levels. But the bubble, the reasoning is logical. Now, let me start from a meta level, the easiest level, saying I do not understand AI, so I do not know what the consequences will be. And let's be honest, nobody really does. But I think if we write a history books in 300 years' time about this period and the period before, I think that AI will be placed on the same level as the wheel, the fire, agriculture, so it's big. That's one point. So from that point of view, I think we cannot afford not to be invested basically in AI.
It's a general purpose technology. Yeah. It can be used in different ways.
Absolutely, and that's a good point.
Thank you.
You really
really very sharp today.
Let's take electricity, for example. I was not going to talk about that because I couldn't start this. Let's take electricity. There was, when that came on, there were very big groups that said, oh, it's dangerous and all the cows will die, and they make big posters because you could get an electrical shock and so on. And then they said, are you going to build this infrastructure, all these lines and all these wires just to light the lamp? But of course, new technologies come, general purpose technology. All of a sudden you have computers and you have televisions and radios and cars, and that will be the same with AI. So I think we should be involved in that. Now, the reasoning, and to a certain extent I understand it, the reasoning why people say it's a bubble, they say, and there is always a logic behind the explanation, this is exactly the same as with internet. This is, if you look at NVIDIA, it's Cisco all over again. Cisco was the poster child of internet. NVIDIA is the poster child of AI. Cisco made the routers and the switches the heart of internet. NVIDIA makes the chips the heart of AI. And they look similar. And the valuation looks similar. So this is all the same as a bubble, and we're all going to die. Now, I think there's a big difference. And that's something Koen and I, we've dreamed up. We've not for once stolen from anybody else. We tend to borrow ideas from other people, but this is what I think. These are NVIDIA's and Google's and Meta's and so on are what I would call two-cycle companies. And what we look at here today is something that's unique, and that's very important to understand, unique in financial and economic history. Typically happens when there is a new technology, internet, or automobile, or trains, or plastics, or computers, or whatever. Typically, there are not a lot of companies quoted on the stock market yet. There is a new idea, so you see the birth of a lot of new companies. When internet came about, very quickly you had 500, 600, 700 listed companies that all were doing something in internet. And with hindsight, you could say that was a very stupid idea, or that was a better idea, or how could we have invested in stamps.com or pet.com? But okay, everything gets financed because everybody's extremely excited at Schumpeter, at creative destruction. A lot of money flows to the space. It's like a laboratory. New companies emerge, new ideas are being tested, and of course some are bad, and the companies go bankrupt, some are good, and that are the Amazons and the Metas and the Googles. But now, okay, you have OpenAI, that's not quoted yet on the stock market, but for a large part, the lion's share of all the added value, the gains, are being made by companies that already existed. And therefore, I call them two-cycle companies, because when you have an explosive growth phase, like internet, well, your stock does not double or triple, it goes times 50. Yeah. But if you can do that 2 times, like NVIDIA does, well, you quickly get to a market cap of 5,000 billion. That's logical. If you have this explosive growth phase 2 times, Well, it's logical, and therefore I say it can go down 30-40%. But if you look at it, there's a strong balance sheet, generating cash. At the end of the internet, when they closed the financing tab, okay, all the big guys, they died off. But that's not going to happen to NVIDIA. So in a way, I think we have to be invested there. But on the other hand, we should also be open to other ideas, upstream and downstream, because of course the valuations of some of these companies are high. But if you can find suppliers, and then you look at commodities, you look at energy that supplies the AI revolution, that's a good idea. And then on the downside, the downstream, you can start to look at companies that benefit from that, financial institutions, biotech companies, and others that will use AI to gain productivity.
Keeping an eye on time, I don't want to deprive you of your passion for commodities, so maybe let's dive into that one real quick.
Well, it's not really a passion, it's only we like it because we think it will make money. And we've been talking about it also in our book, The New World Economy in 5 Trends. A couple of years ago when everybody said you're absolutely crazy that you have dared to predict that gold will go to 4,000 and silver will go to 50. Well, that's the levels where we are today. And I still believe that we're in the strongest and the biggest bull market in commodities of all time. So this is maybe not the first inning, but it's maybe the second or the third inning. We're nowhere near the end of this. But this year we have seen gold, we have seen silver, we have seen platinum, we've seen palladium, we've seen copper, lithium is adding. So gradually you see new commodities adding to the list, and that's what you absolutely want to see in a bull market. It's on the demand side, like I said, because AI will create electrification, will create a lot of demand for copper, for energy, and all these other things. But most of it, and therefore it's such a big bull market, is a supply thing. We all know you need about 200 new mines in copper. Even if you were to try to open them today and put all the energy and all the cash and all the permitting, because that's not easy to open a mine in it, well, it will take you at least 10 more years before you have the first ounce of copper. So all these things will go into deficit, and that will create the opportunity. So we've talked a lot about opportunities, but do not forget the commodity space. It's maybe a nice quote that I borrowed from somebody else somewhere, not from Koen, but I don't know from whom. The more virtual worlds we build, the more we need the atoms and the molecules of the real world. Yeah. And the atoms in the real world are way cheaper to invest in than the virtual worlds. So I think, yeah, that energy commodity space is something extremely exciting to look at.
Maybe very quickly before we see if we have a question from the audience. We talked about oil before the interview. Quick word on...
Well, a very quick word. That's basically the piece of the jigsaw that's still missing in the commodity bull market, because oil and energy and liquefied natural gas is still the biggest part of the commodity space. Up until now, it's not participating to the upside because, like I said, a lot of commodities are in deficit and that drives prices higher. Oil is still in surplus. But if you look at the added surplus that has been created over the last, let's say, 10 years, 95% is American shale and is Permian base. And we think, and not only we, but people are very close to that, think that Permian base supply is topping out. And then at a certain moment in time, maybe not this 2026, but somewhere, you will go from a surplus to a deficit. And I think OPEC Plus will defend the 60 to 65 level to the downside. I think there's a lot of upside. And I would not be surprised to see oil at $100 somewhere next year or the years after that. And even it's priced so cheaply, nobody's talking about oil. Everybody hates it, just like everybody hated gold a couple of years ago. So I think there is an out-of-the-box opportunity. It's not number one in my list, but if you ask me for an opportunity a little bit out of the box, I would take energy.
Yeah. Okay. Perfect. We're almost over time, but let's quickly go to 2 questions. Koen, question for you. I can go short. What do you think of the government agreement?
It's a nasty question.
Nasty
question.
It starts with a B, it ends with a D, and there's one other letter.
Well, it's not that bad. It's good that we have. It's good that we have an agreement.
Yeah.
That's for sure. Because otherwise, I think we would be. I think that financial markets would focus on Belgium, and we would certainly live through our trust moment. All of a sudden, you see interest rates rise, and you have then the knife on your throat. And at that point in time, you have to then you have to push that. But if we look to the agreement itself, what you see there is that about 60% of the total reduction of this primary deficit is going to be realized via reduction of spending, and 40% via an increase in income. And that's not good. That I rather would see 90-10, or at least 80% less spending, 20% more income, because what you're going to see is that, okay, all the time, every country that's reducing its primary deficit, you see that economic growth is slowing down during that period. But also after this period, I think we will see an economic growth that is certainly not higher and probably lower than the economic growth we have seen over the past years, because we don't reduce our spending and we increase our taxes. And you know, when you increase in taxes, purchasing power is going to go down. So that is not the best way to do it. But okay, it is what it is.
Final question from the audience. What about antimonies?
Well, I think the viewer, or it means antimony, the commodity. Well, that's not a rare earth. It's not in the list of 17, but it's still a critical thing. You need it in when you want to slow down fire. You need it in ammunition and so on. And of course, like a lot of these commodities, is produced and refined mainly in China. So I think the rare earth, Koen, and the strategical metals, because they're sometimes mixed up, are a very interesting thing. Now they have a deal with China, so they're flowing again more or less. So these stocks went up 10, 20, 30-fold, and now they've been cut in half, which is still a little higher than where they were. Now, everybody says, okay, the rare earth story is a little bit over, but it's absolutely not, because China will continue to use this as a bargaining chip in each and every negotiation that will come up in the future, and there will be negotiations. So I think that Europe and US will try to build critical infrastructure, but that will take time. US is ahead of Europe again, because we have also a critical mineral act, but we're not doing a lot with it. But antimony is one of them. Problem with this is that you cannot, it's very difficult to invest in them directly. There are some very small companies quoted, they're very illiquid, they're very dangerous. They can go up 120-fold and then fall 50%, you know the volatility. But I think you should find a way, it's an extension of the commodity team, you should find a way to invest in this and other related stuff in a portfolio, maybe in a sort of a fund, in sort of an ETF, which are not available either, because you want to spread your risk. But I'm a big believer that this is also, once again, a very interesting space to look at.
Thank you very much. I can see that we are still getting questions in, but unfortunately our time is up for today, but we will be collecting the questions. Thank you.
We will give an answer.
And we will give an, of course, we will give an answer. Yeah. Thank you very much, Koen and Philippe, for your clear and in-depth insights. We've learned a lot today about China, the US, commodities and the markets. Once again, thank you to all our guests for being present, and we're already looking forward to our next LinkedIn Live.
Thank you, Thomas.